Welcome to Beyond by Wings, the business side of dentistry, brought to you by Edwards and Associates PC. Join us as we discuss how to build your dental practice, optimize your income, and plan for your future. This podcast is distributed with the understanding that Edwards and Associates PC is not rendering legal, accounting, or professional advice. Listeners should consult with their business advisors before acting on any of the information that is shared. At Edwards and Associates PC, our business is the business of dentistry. For help or more information, visit our website at enassociates.com. Hello and welcome to another episode of Beyond by Wings. In today's episode, we have a very special guest. His name is Paul Sippil. I don't think I've ever met anyone who does what he does, and that was part of the reason why I decided to have him be a guest on our show, because I do think that he will bring a lot of value. So without further ado, Paul Sippil, how are we doing today?
I'm doing great. It's great to be here.
Excellent. As a forensic 401k consultant, tell our audience and our listeners a little bit more on what that is.
Yeah, absolutely. I use that term along with 401k vigilante to really capture what I do, and that's focus on exposing conflicts of interest, excessive and unnecessary fees, the general lack of transparency, and sometimes even outright fraud in the group retirement plan industry that includes 401k, profit sharing, and 403b plans primarily, and sometimes even defined benefit plans. And if you don't mind, I'll explain a little bit about kind of how the term really evolved and how I got started and what motivated me to do what I'm doing right now and really what influenced me.
Please go ahead.
I remember a conversation, it was probably a little over 20 years ago now, with a colleague who told me that you could actually look up companies' retirement plan tax forms online. And I just thought that was fascinating, that that information was actually a matter of public record. But I really didn't know what to do with the information initially. So I waited a few years and it was always in the back of my mind. And then I started thinking about it a little bit more and I started looking up a few companies' tax forms. And then I thought, maybe I should call the business owners, see if I can get through to them and let them know what I see, especially in instances where the fees seem to be especially large and in proportion to the number of participants, because really the fees being charged should be commensurate with how many people are in the plan, because that's essentially what drives the level of services provided. But the responses that I got were not what I thought. They were primarily, I'm working with someone who takes care of that for me and I'm not paying any fees. And when I got responses like that, and those responses demonstrated such a misunderstanding of how these charges were being applied and the fact that they were very much being paid by the participants in the plan, I realized I could focus just on this one area, just in the Chicago area alone, and still maybe barely make a dent, but that essentially I could make a whole career out of just being a consultant, just helping people peel back the layers in these retirement plans. And what better term could I use than forensic 401k consultant?
That's right. Yeah. I mean, that's good and it's catchy. I mean, I like the vigilante one better, but professionally speaking, I think I like that.
Yeah.
Okay. That's good. Wow. And you honestly, I mean, you must have seen enough of this for you to think I could actually do this full time.
Yes. Fiduciary malfeasance is a term I would use to describe so many plans, to the point where fiduciary malfeasance, at least in smaller plans where the fees are even more egregious per participant, are the norm, not the exception, the norm. And I don't think most people even remotely grasp that concept. The fact that you can be an investment broker, and there's different ways investment advisors get paid. There's different types of investment advisors. In many cases, in these smaller plans, and by small, I mean generally fewer than 100 employees, the investment person is known as a broker who's receiving commission payments, which are especially nefarious, not only because they're based on a percentage of the total plan assets, which is totally divorced from the level of services being provided, but they're buried and embedded within the funds, and there's no invoice being sent. So there's no incentive to control any of the costs that you don't even understand exist. And I'll share with you something that had just happened to me yesterday. And I never was able to tell a story like this because I never experienced something like this happening. I was talking to a potential client
Mhm.
just about all these broker's commissions that I was seeing. And the broker's commissions were significant. It was only had a few people in the plan. They were, almost up to $10,000 a year as of last year, and they didn't even know that they had an advisor and they were paying anyone. Upon finally looking into this, per my instructions of contacting their administrator to find out who the advisor was, they learned through Googling that the advisor had died 11 years ago.
Oh my goodness.
Yeah.
Wow.
This isn't even that shocking. There's probably a lot of other instances like this, but there are clearly many other instances where an advisor is being paid. And not only are they not using the advisor services, they don't even know that there is an advisor who likely sold them the plan upon inception and then just got increasing compensation due to increasing plan assets. Because as I mentioned, the compensation is tied to the plan assets. The more the assets, the more the contributions, the more the compensation that's paid out to the broker.
That's insane. Wow.
Yep.
Wow. Wow.
Yep. So, in Chicago, dead people apparently can vote. And in addition, dead people can earn brokerage commissions off of retirement plan accounts.
That's crazy. That's insane. Would you say it's one of the more well-known brokers out there?
I'm not sure. In fact, I don't even know. I didn't even know who the broker was. The brokers, there's lots and lots of different investment brokers out there, and they all pretty much engage in the same practices. And many of them, like I used to be at my old firm, are restricted to only working with certain record keepers. In fact, when I was making critical remarks of a company who provides record keeping services for retirement plans called John Hancock, it turned out that my company had a relationship with John Hancock, meaning that that was one of the approved record keepers that we had that we were allowed to recommend. Well, it just so happened that the record keeper on this plan, where the advisor was dead for 11 years, was also John Hancock. And John Hancock was getting sued for excessive fee lawsuits at the time when I was raising concerns about their practices. And John Hancock got wind of some of the emails I was sending out and then sent them to my old firm because they knew they had a relationship, which my firm then promptly told me, you cannot criticize anyone we have a relationship with. And that's the expanded story of why and how I became a 401k vigilante, is that I didn't want any third party pulling my strings and telling me what I can do and how I could do business and who I could recommend. So back around May of 2010 is when I decided to leave and go off completely on my own to be an independent fiduciary and registered investment advisor, allowing me to be completely objective.
Wow. So my next question would be how what do you do once you find out something like this is happening?
Well, there's a lot of layers here. Once you find out that you have an advisor that's dead or an advisor you don't use, all you have to do is contact the record keeper. It could be John Hancock, Principal, Securian, Voya, whoever. Those are just some of the big providers. Doesn't matter. And instruct the record keeper to stop processing the commission payments or advisory fee payments, if it's not a broker, to the advisor or the broker, which you are not required to pay. You're not even required to have an advisor. Now, ideally, it's good to have an advisor that you pay a reasonable fixed dollar fee to that's commensurate with the level of services provided and that you're getting something out of that service, as opposed to having an advisor overpaying for an advisor and not even using the advisor. But clearly, it's better to have no advisor and not pay an advisor than to have an advisor that you don't use and pay the advisor. And you're always allowed to negotiate the record keeping fees if it's one of those record keepers that's charging, like the advisor, wrongfully based on a percentage of the total account value. And all you have to do to negotiate, you don't need me. all you have to do is call John Hancock or principal or whoever it is and say, what are you charging us? And can you please charge us a lower percentage? Our assets have increased and your fees are increasing at an excessive rate. And in almost all cases, they will relent and give you at least somewhat of a reduction, which is, something that can save thousands of dollars forever just as a result of a simple phone call.
How do they get away with it? Like, how can one think that, oh, I'm not paying any fees, but then later they're actually charging these fees? And how are they basically, uh, getting away with it without them knowing?
Well, I mean, it is all stated in the contract, but like nobody really understands like what they're getting into. They just don't understand the concept that fees are being charged to participants. And I think the way they get away with it is that they don't send an invoice, because it would be really easy to know what you were paying, or the fact that fees are being processed from participants' accounts, extracted from their accounts, if the
Mhm.
advisors and record keepers would take this one simple step of sending a quarterly or monthly invoice, or however often the fees are being extracted. In fact, if the invoices were being sent, or ideally, if the employers demanded, and I'll get to why this is so important in a minute, that the fees be charged directly to them and not the participants, because then not only would they have to get an invoice, but they would then physically write a check, which automatically makes you more sensitive to cost. And I'll add that economist Milton Friedman, you might have heard of him, famous economist, talked about the four ways to spend money. You can spend your own money on yourself, your own money on someone else's money on yourself, or someone else's money on someone else. And in the latter case, you don't economize and you don't seek the highest value. In other words, when it's not your money, and oftentimes it's an HR director or CFO, or sometimes it is the owner that's overseeing these decisions, and a lot of the money is other people's money, then there's no incentive to understand the cost, or to get the highest quality services, or to get the most reasonable price.
Hmm. Hmm. That's right. Well, here's my other question to that. Why would an employer be incentivized to take on that cost themselves?
Okay, so this is what I really wanted to get to. And that's what I said when I'll talk about that in a minute while the employer wants to pay. This is a great segue to do so. And I'll use dental practices as an example.
Mhm.
So, in cases where the vast majority, or at least the majority of the money is the owner's money, and that could be one or more owners, and this is often the case in professional service firms like engineering, architecture, law firms, and medical practices, including dental practices. In those cases, in any case, the participants with the largest balances are paying the largest share of the fees. So in those cases, if the owner, or let's say the doctor or the dentist, has 80% of the balance, that means they're paying 80% of the participant fees anyway, and with non-tax deductible dollars. So not only are these fees excessive, but boy, wouldn't it be nice to at least get a tax deduction for these fees? And you can't, they're not deductible. And even if they were deductible, people wouldn't know to deduct fees that they can't see because they don't get an invoice for them. However, if you're paying at the employer level, not only are you naturally, as I mentioned, going to be more sensitive to the cost, but you're also, like any other business expense, you're going to get a tax deduction. So wouldn't it make more sense, if you're already paying 80% of the fees out of your personal pocket anyway? And oh, by the way, in a tax advantaged account that almost all financial advisors, pretty much all financial advisors, really, I should say, that will tell you to have as much money staying in and growing inside of, then you might as well have as little fees, ideally zero as possible, being extracted from an already tax advantaged account and pay at the employer level. Wouldn't it be better to pay 100% of the fees and maybe pay a net 65 to 70% because you're getting a tax deduction at the employer level, saving everyone else money and incentivizing everyone else to participate, than paying 80% of the fees with non-tax deductible dollars in a completely non-transparent way out of your personal account, when you're not even sensitive to the costs, which are almost always going to make the cost unnecessarily skyrocket.
Mm, that's true. And it also gives you the compounding growth in favor of the participants since the fees are not coming out from them.
Exactly. And there's ways to quantify that compounding growth too. I mean, just as, with a basic calculator, use ChatGPT to say, what if I had a 1% reduction in my fees over time? In fact, I can give you a mathematical example from the Department of Labor. With a 35-year-old participant with a $25,000 balance as a result of paying an extra 1% in fees over a 30-year period, that participant will pay approximately $67,000 in unnecessary fees over their lifetime, which equates to about 28% of their balance. And that's just for that kind of participant. Imagine how much extra money a doctor will pay with a much bigger balance at that age with much larger contributions. It's going to be hundreds of thousands of dollars at least. And it's crazy how people are not sensitive to costs they don't see and don't even believe they're paying anything because they never got an invoice. And it's hard to believe you actually paid a fee if you never saw the fee come out of your account. But just because you don't see something doesn't mean it's not real.
I see. Now, how favorable are these companies to these changes? Let's say the employer calls them and says, look, I want you guys to send me an invoice so that I can pay for it directly, or my company can pay for it directly.
Well, in terms of how they get their money, none of the companies actually care. However, the brokers cannot make money that way. As an investment broker doing business only on a commission basis, they can only get paid these commissions, otherwise known as kickbacks, that are built into certain investments and not others. They can't actually get a direct fee, and for that reason, they're not legally able to provide advice. If I charge you $1 and I tell you what to do, that's giving you advice. If I sell you an investment and get a commission for it, that's just selling you a product. So in some cases, they're not even allowed to do that and don't want you to ask. They also don't, the advisors don't want you to know you can negotiate with the record keeper, because think about it. If you can negotiate with a company like John Hancock, wouldn't the next question be, hey, Mr. Advisor, I just found out what John Hancock was getting and I never knew. Come to think of it, I don't know what you're getting either. So if I'm going to negotiate their fee, the next thing I'm probably going to do is negotiate yours. And why would they even bring that matter to their attention and open up that possibility?
That's true. That's true. Yeah. And as I'm listening to you, I also remembered something you mentioned during in the earlier part of this episode, where you said that you also see a lot of fraud in group plans.
Yeah. The fraud, well, what I've described is certainly, I think, fraud when you're essentially not doing anything and getting, in many cases, $20,000, $30,000 or more in commissions per year. And I actually have an Excel spreadsheet, having gone through tens of thousands of companies with over 1,000 examples of some of the most egregious situations where excessive and unnecessary fees are being passed on to participants just throughout the Chicago area alone. But some of the more blatant fraud is when the advisor is a personal friend or a family member or somehow related to the owner, who is allowing for this excessive compensation to be paid, not only with his or her own money, but with the other participants' money. And that's essentially using employees' retirement funds as a personal piggy bank to dole out favors to friends and family.
Mm-hmm. Can you do something in that instance if you are made aware?
Well, as a participant, you can certainly make the owner aware of these issues. And in fact, since the owner often, as I mentioned, has the largest balance, the owner should listen. But unfortunately, from a legal perspective, these plans are way too small. The ones who are getting hurt the most are way too small for any attorney to want to take the time to engage in legal action. When you hear about 401k plan lawsuits, these are billion-dollar plans, maybe several hundred million at the smallest. But these small plans with, fewer than 100 employees or even a few hundred employees that have under 100 million in assets, they're just unfortunately insulated from lawsuits, not because they didn't do anything wrong, but because they're too small to get anybody's attention.
Okay. So then what kind of tips can you give to our listeners on how to do it right from the beginning, or to mitigate or minimize some of these risks?
The easiest thing to do, and this is especially related to dental practices, because if you're making money and you're paying a reasonable fee, you can easily, in most cases, afford to pay for all of the 401k record keeping, administrative, custodial, and advisory fees. Because when you're getting directly billed, especially by the advisor, you're just not going to agree to pay the advisor that much. And there's some very good record keepers out there that have very few, if any, restrictions on the funds, one of which is called a census. And by the way, I get no kickbacks from them, no compensation from them. I have no financial interest in this company. It's just a good company that charges a very transparent, clear, low fee for all their record keeping, custodial, and administration services for defined benefit and defined contribution plans, that you can write, and you can write that firm a check. You can pay at the employer level. When you start paying at the employer level, all these problems pretty much go away. It's really that simple. And because a census's fee is a flat fee, and because if you work with an advisor, my fee is a flat fee. You don't have to work with me. I'm just giving you an example. If you're paying a flat fee to a census and you're writing them a check and you're negotiating a flat fee, like, X amount of dollars per quarter, that's based on the value that you see in the service, then a lot of these problems, I think, will go away. Now, there's a little more to it where you want to make sure the advisor is recommending funds that are more than just something generic. I mean, if they do, you want to pay the advisor less. And this is something else to look out for, that most investments, and even the guy who invented the 401k, his name is Ted Benna, has echoed the same sentiments as me. And what he said is advisors are getting paid as if they're doing an original piece of work. That's just bizarre and inefficient. Advisors need to get back to a fee for service model like accountants and attorneys, and simply help people retire and focus really on helping people retire by helping utilize the record keeper's retirement plan calculator, helping draw distinctions between Roth and traditional 401k and how much to put in each bucket, helping select and monitor the funds, of course, which is the only service most advisors tout. And then, of course, helping figure out how much participants should be contributing and if they should pay off debt first or invest in other accounts or establish a 6-month or so savings cushion before maxing out or contributing more to their 401k. Those are the services that an advisor should be providing. And there should be a fee charge for that service, really, that's in proportion to the number of participants in the plan and the number of one-on-one meetings that participants are having with the advisors, whether that's on Zoom or on a call or in person. And this is something I can't stress enough, that most companies, owners, don't even know or care whether or not the advisor is conducting those one-on-one meetings with participants, which is really how they get the most value out of the services. Because again, the company doesn't get billed, and the company doesn't even get an invoice to reflect the fees coming out of the participants' accounts. But that's the most important question to ask or get involved in that process, because if the advisor is not conducting one-on-one meetings with participants and the advisor simply recommended some very generic cookie cutter investments that a fifth grader could select that require very little, if any, monitoring on an ongoing basis, then the advisor is pretty much not doing anything. Even if they're getting a flat fee, which is better than a percentage if there's lots of money, you still don't want to pay an advisor to do nothing.
That's right. So, would you say that there are advisors out there that would proactively set up these one-on-one meetings right before maybe,
Yes, but not that many of them. So when you look at the demographics of the industry, you will find that the vast majority of financial advisors do not handle 401k plans, 403b plans, or profit sharing plans at all, partially because they don't understand them, partially because they view it as time consuming, and for that reason, they just don't want to. Of the advisors that do handle 401k plans, most of them only handle one or two plans and use it kind of as a means to get in the door so they can sell money management services and other financial products to the high net worth participants in the plan. So their enthusiasm for spending a lot of time one-on-one with all the participants, a lot of whom don't have necessarily a lot of money to manage, is very low. And the other thing is that if they can market themselves as fund pickers, stock pickers or mutual fund evaluators, which again takes little or no work, especially to the extent that the funds are generic, and they don't send a bill, then the plan sponsor, the owner, is never really going to demand one-on-one meetings because the owner doesn't even realize that the real value is in spending time. And if the advisors can convince the owner that monitoring and selecting investments, as simple as it actually is a really complicated process that the owners shouldn't handle on their own, then that's great for the advisor. They're the money manager. So even though they're not managing anything because the accounts are participant directed and the advisor can't make any buy-sell decisions, but if the advisor is marketed that way, then they can make lots of money, charged based on a percentage of the account, get guaranteed increases in their compensation based on the contributions pushing up the assets, and then their service model and their fees, which nobody sees, will never get questioned. So as a result, they have very little, if any, incentive to conduct those one-on-one meetings. And they also have very little enthusiasm for the 401k business because most of their money is made by selling individual products to the high net worth individuals in the plan.
I see. But still, the interest needs to come from the employer level for it to become a thing.
That's true, because to the extent, and the advisors are happy if the employer isn't interested, because they don't even know they can fire the advisor. And the less interested the employer is, the better it is for most advisors. But yes, for someone like myself that truly cares about providing value and spending time with the participants as the primary value proposition, there needs to be cooperation with the employer. Otherwise, I'm just sending them a bill to have me on file, but they're not really getting the most use out of me. So I really, truly try, and I think if you are an advisor, you should truly try and push the employer to engage and spend some time and continuing to communicate with the participants that the advisor is going to be coming in for in-person meetings. And then when the advisor actually comes in, more people tend to talk to the advisor.
That's true. And I think this would be a good point to for you to share your contact information with our listeners, because I do believe there might be people out there that may be willing to utilize your services.
Sure. I can be easily found just through my name, paulsippil.com. There's a litany of information that I've shared on my website. If you really want to learn about the ins and outs of 401ks, I've got lots of videos on YouTube. You just find my channel, just type my name into YouTube. And I think it's just youtube.com/@Paul Sippil. And you'll find a lot of my content there as well. And my email is listed on my site. It's just my first initial, last name, psippil@paulsippil.com.
Awesome. Amazing. Well, you did share a litany of information on this episode as well. And I think there's still a lot more to talk about, which may be more individually catered. But I'll leave you to that conversation with the people that may call you. But thank you again for being on our episode. It was really amazing and fantastic. I learned a lot. So thank you for that.
Thank you. It was great to be here.
Absolutely. Thanks for listening today. Be sure to subscribe to Beyond by Wings on your favorite podcast platform. For more information, you can follow us on Facebook, Twitter, and LinkedIn, or reach out to us on our website. You can also shoot us an email at info@eandassociates.com.